What do you make of a little bit of a rebound here in some of the performance?
Taylor, thanks for having me. Good afternoon. It's certainly nice to see. Munis have held up well here in the last month, but putting things in perspective, Munis have held up pretty well throughout the year. It's obviously been a very difficult year for investing, not just in fixed income, but across the board. U.S. Treasuries are down about 9.5%, the U.S. Ag down 10, corporate IG down close to 14, and here Munis are down about 7.5% on the year. I think it speaks to somewhat the defensive nature of the asset class, but also the fact that there's less volatility in munis than we've been seeing in the overall rates market, and demand has started to come back, which is certainly a positive. We'll take it.
Is that sort of defensive nature the reason why you're a little bit more neutral, maybe pivoted towards long duration versus short duration, even if in the face of sort of rate hikes backing up here in the face of a Federal Reserve meeting in just a week?
Yes, very good question. Obviously, we get the Fed next week. It's our view that they'll go 75. It'll be important to listen to how they lay out the cadence for rate hikes for the balance of the year. But at the same time, the front end of the curve has seen a lot of demand. I would say it's probably one of the richest parts of the curve. We've been seeing a bit more opportunities in the belly and out longer on the curve, where we can pick up a bit more yield and play a bit more of the structure that the muni market offers. So yes, I would certainly agree. If you can pick up 80% of the entire curve by just going out 10 years, and you can again look at tax equivalent yields that are north of 4% in 10 years and north of 5% in 30 years, there's good opportunity out there for those that are willing to take it.
Is more of a neutral rating in high yield based on some recessionary fears out there?
It is. I would say, typically munis do okay as you head into a recession. One of the reasons being that, tax receipts are rather sticky, while you go into a recession. So unless you're calling for a very deep recession or very prolonged recession, munis will hold up somewhat well. But what we've seen in high yield, obviously, it's a longer duration play. And we've seen, a decent amount of kind of speculative deals come to market and not see quite the demand that they were just maybe 6 or 12 months ago. So more of a neutral there, and favoring more of the IG over high yield at the moment.
How do you think about more of the path of monetary policy in the face of rising rates? How do munis typically perform if we're thinking of 75, maybe now even 100 in some cases?
Yeah, we're more in the 75 camp than the 100. But that said, again, munis tend to perform well heading into a recession because the fundamentals hold in. Sure, maybe muni credit is in the process of plateauing, but that still means that we'll see good state and local budgets and good fundamental story for at least the balance of 2022 into 2023. I think that the cadence of how we get these rate hikes and the length of time that the Fed has to raise rates before we start to get into a situation where maybe growth is slowing, will be key for munis.
Does the reopening trade, airports, MTA, subways, does that still work?
It still works. I would say, some of the low-hanging fruit has probably been taken there, but it does work as we continue to see more employments and more activity going on. It continues to work, but we still favor kind of those higher quality, more sticky sectors that you'd anticipate in this type of an environment.